Okay, so we'll get started on time. So welcome to the Expat Tax Thailand webinar for South African asset holders in Thailand to explain the specific South Africa double taxation rules for personal income tax in Thailand. I'm Carl Turner, I'm the co-founder of Expat Tax Thailand. The purpose of this presentation is just to provide you with the up-to-date information. Here at Expat Tax Thailand, we're really here to help individuals understand the filing requirements and obligations, understand the rules so they can make better informed decisions. We're here to help. So who's this content actually for? It's for any Thai tax resident that's got assets in South Africa, or for people that are considering moving to Thailand that do have South African assets. As mentioned, I'm the co-founder of Expat Tax Thailand, and we really are here to help expats understand the rules, make better informed decisions. All of our accountants are authorized and regulated by the Federation of Accounting Professionals. And today I'm delighted to be joined by Samantha Pillay from Excellent Accounting and Tax Services in South Africa. So Samantha, she'll be helping answer questions on the South African side, while I'm here to help explain the rules and the tax filing obligations for the Thai tax returns and for Thai tax residents. So welcome, Samantha. Thanks for joining.
Thank you so much, Carl, for that warm welcome. I'm happy to be here today, and I'm happy to answer any questions that you guys have as well.
Wonderful. Thank you very much. I'm sure there'll be quite a few at the end. So in our webinar today, we'll go through a few case studies and we'll talk through what the Thai tax rules state, specifically around certain types of South African assets. So if they are remitted, so what does that mean? It means transferred to Thailand. We'll talk about what assessable income is and what it isn't. We'll explain what are the requirements and who needs to actually file and how do they file if you need to. Then we'll talk about allowances, deductions, common reporting standards. How will this all be enforced? And then we'll get on to the Q&A. So the main part is we'll talk about certain assets. If they're remitted to Thailand from South Africa, what does the double taxation agreement say? So we'll go into how South African pensions are taxed or how that looks, property rental income, sales, dividends, and investments. So we'll go into that in detail. First of all, if you do have any questions, I recommend that you look at our website and the Ask a Question section. We've answered hundreds of questions regarding the Thai personal income tax questions. So if you'd like to view on there. Also, if you're watching the live webinar, just put it in the Q&A box and we'll get to it in the end. So just a quick disclaimer before we start, the contents provided is for information purposes only. It doesn't constitute professional tax advice. Shouldn't be acted upon on isolation. So who actually has to file and what are the requirements? So if you are a Thai tax resident, so 180 days or more in a calendar year, and you have assessable income. So what does that mean? It means things like pension income, rental income, investment capital gains, dividends, and you send this to Thailand. If the amounts are over 120,000 Thai baht and you're married, or 60,000 Thai baht and you're an individual, then you need to file a Thai tax return. You could potentially offset the tax with credits when you file. If it's pension income, then these requirements are doubled. So you can bring in 220,000 Thai baht of pension per year before you have to file. Or if you are single, it's 120,000. So the basic requirements for who has to file. If you do have to file, what do you need to do? Well, first of all, you need a tax ID number. You can get that at your local revenue office, or we have a service to obtain this on your behalf. You have to file a personal income tax return, which is PND 90 or 91, depending on your circumstances. The tax year runs the 1st of January to the end of December, and you need to file a tax return in the following 3 months or 4 months after the tax year finishes. So you can file yourself, or you can use a tax filing service like Expat Tax Thailand. So let's talk about DTAs. So we've had many webinars on specific country double taxation agreements, and this one is on South African Thai double taxation agreement. So I think it might be good really just to start with, we have a lot of questions about double taxation agreements. I thought it might be good just to start with, what are the common misconceptions that we get? So I thought maybe it might be good to pass across to Samantha just to talk about, from your experience, when there's a double taxation agreement in place, what are the common things that clients say? What are the common misconceptions from individuals regarding these that you see?
Hi, Carl.
Hello.
So a few of the common misconceptions that I do have is, so if clients are moving over, for example, to Thailand, so they would think, they've only taxed in Thailand. So if they're coming from South Africa, the misconception is that they are not taxed in South Africa as well. But in South Africa, you are taxed on worldwide income. So any income coming from South Africa, you are also taxed on exception of the double tax agreement if there's any exemptions in there. So that is one of the common misconceptions that we have. And also, if people don't submit their South African tax return as well, which accumulates a lot of penalties on our side. So being here and being knowledgeable of what's actually in the DTA is quite informative on your side. Thank you.
Yeah, great. Yeah, thanks for that. So the common things that we see is when they see that there is a DTA in place, then a lot of people feel like that means they don't need to do anything in Thailand because they're already taxed in South Africa. Well, that's not the case. We have to look at the double taxation agreement and see if you remit those assets to Thailand, do you still have to file a tax return in Thailand or not? So that's really important. And for most assets from South Africa, we still have to file, but we can use the tax as a credit. So that's really important that people know that they do have an obligation the majority of the times to file at least. Yeah, so thanks for that, Samantha. So what's actually been announced with the Thai tax rule changes? So it's 15th of September. These are the key dates. The last year, 2023, the Thai Revenue Department issued a departmental order to overrule a previous ruling. In November last year, they actually produced another piece of documentation, which is the one on the right, which actually explains cash in the bank from previous tax years. That's really important. So it means there's a big change to the tax rules in terms of if you earn the year that you remit in foreign source income, you have to file a Thai tax return rather than having the previous rules, which was if you left the money overseas for one complete tax year, brought it in the next year, it wasn't taxable in Thailand. Now, it's a remittance basis still. You're only taxable if the money's remitted to Thailand, but you can't leave the money overseas for 1 year and then remit in. It's taxable in the year that it's brought into Thailand. What are the key dates? Tax year, as mentioned earlier, is the calendar year. And the last date to file a tax return, the physical paper tax return, is the 31st of March next year, 8th of April if you file online. So the Revenue Department, they've done a good job to actually produce a lot of documentation to explain how do foreigners living in Thailand pay tax. So they produced about foreign source income and how it can be included on your tax return. So they produced that in July last year, July this year, to explain how people need to file this current year. So who do these new changes affect? Well, anyone who's a Thai tax resident. So the definition of a Thai tax resident is someone who's been in Thailand 180 days or more in a calendar year. And this doesn't really matter on the visa status. So if you've got a tourist visa, elite, permanent resident, it doesn't make a difference. It just means if you've been 180 days or more, you're a Thai tax resident, and you have to comply with the rules. The only exemption is the LTR visa, the long-term residency visa. It can help potentially with foreign source income. There are strict requirements from this. It's got a royal decree that's exempt from foreign source income. We've got a webinar dedicated to this. It might be worthwhile watching if you meet the criteria to qualify. So it seems though there will be further changes to the Thai personal income tax rules. There's been reports in the Bangkok Post over the past few months that the Revenue Department are drafting further changes for future years. So specifically moving towards a worldwide taxation basis. We don't know how this will look, but we'll know that there will be further changes, and we will inform people of what this means to them. So to stay up to date with any further changes or announcements, you can sign up to our tax alerts. So you can either take a picture and sign up with the QR code, or add to the click on the link for our tax alerts on the website, fill out your details, and we'll make sure that you're kept up to date with any future changes. We've also got a lot of other videos and resources for different subjects, specifically around capital gains, pensions, and other types of assets, other than the DTA webinars as well. So let's go back to Thai personal income tax rules. What is actually taxable in Thailand? So you can see this is section 40 of the Revenue Code. There are 8 different parts. We can see part 1 is where salary and pensions come in. Part 4 is investment gains and dividends. Rental incomes, part 5, and property sale is part 8. So you can see most income sources, if they are remitted into Thailand, are classed as assessable income. So now we know that the majority of assets are assessable income. What's not taxable? So really important to look at this. Thailand is a remittance tax basis still. Unlike South Africa, where you tax on your worldwide assets, it's actually just a remittance tax basis. So only on assets that you remit, transfer, or spend in Thailand as a Thai tax resident. So it's not taxable if you keep the assets overseas. If you remit the income from previous years, so pre-2024, if you've got cash in the bank from previous years, the balance as of the 31st of December 23, you can remit in without any tax implication. That was the announcement in November. If you bring in original capital, let's say you've got investments or a property you sell, you don't make a gain, you can bring that in. That's not assessable income. You've got inheritance from overseas, that's not assessable income in Thailand. If you make gifts, that's potentially not taxable, but it's quite complex. Loans are not taxable. Also, if you're a non-Thai tax resident and you remit in foreign source income, that's not assessable income. So if you're under 180 days in Thailand, you can remit in foreign source income. And obviously the LTR visa, what we mentioned earlier. So let's assume you do have assessable income, then what happens then? So we look at the allowances and deductions in Thailand. We don't look at the South African allowances and deductions. We look at specifically the allowances in Thailand. So everyone gets a personal allowance, 60,000 baht. If you're married and your spouse has no income, you get their allowance as well. If you have children, you get allowances. Health insurance, it's got to be a Thai health insurance. You get other allowances and life insurance. If you're 65 or older, then you also get another 190,000 allowance. So once we've got all the allowances added up, we deduct that off the your assessable income. Then we look at the Thai tax table. So it's a progressive tax system like most others. The first 150,000 is tax exempt, next 150,000 at 5%, and then it goes up. So if you bring it in over 5 million Thai baht of assessable income above your allowances and deductions, then it's 35% tax over and above that. So just a quick note to say, we're here to help. It's confusing for people not in the tax world. It's not necessary to understand this fully. We can help calculate the taxes and file on your behalf. So we do have an online tax filing service that you can use. You don't need to visit our office, and we can help with answer all the questions with yourself. We have 3 levels of service depending on your circumstances. So let's go into the DTA. So what's the DTA for? Very important for South Africans or people who've got South African assets. It allows you to offset certain taxes for certain types of assets. and also other assets are potentially exempt. So the South African Thai DTA, signed in 1996, 27 articles, 39 pages. It really explains how the assets are taxed, and it covers all the asset types that we were discussing earlier. So there are also 61 DTAs, not just the South African Thai DTA. So if you do have assets in other jurisdictions, you have to look at the double taxation agreement between that country and Thailand. It's really important. So if we've done the hard work, we've researched all 61. We've got other webinars as well for different nationalities, different countries. So if you do have assets in other jurisdictions, you might want to check out the other videos that we have. So let's talk about tax credits, how they actually work. So they may allow you to claim back the tax that you've paid in South Africa, in this case, as a credit against the tax that's owed in Thailand. How do they work in practice? So when you file a Thai tax return, we can use the tax certificate from South Africa to show how much tax you've paid on those assets. Then we can use that to credit for some of the tax that may be owed in Thailand. And we have to make sure it's done in the same year. We can't roll over to other years. So in principle, how does it look? Basically, you tax at source for the majority of your assets in South Africa, whatever the tax that you've paid. When we file the Thai tax return for what you've remitted into Thailand, then that's when we would look at the tax paid for those specific assets and use a credit for that to claim back some of the tax. So you can use a credit rather than paying the tax in Thailand on all. It doesn't mean you don't have to file, doesn't mean you don't have tax to pay. It just means you can offset some or all of the tax with the tax that's been paid in South Africa. So let's go through the specifics. So we'll go through pensions, rental income, like we mentioned earlier, property sale, dividends, and investments. So let's go started with the first one. Pensions, very important for people. If you have a pension paid from South Africa, it states that the other contracting state may be taxed. So what does that mean? It means you're taxed in South Africa on the pension income. And then if you bring that money into Thailand, then we have to file that on a Thai tax return. But we can use, depending on what tax rate you are on, then we can use the tax paid to offset or credit for part of the tax that's owed in Thailand. Might be good for Samantha just to mention how this is deducted, where it's deducted at source, how's it paid, when's it paid, just a bit of information that might be good, Samantha.
Yeah, sure, I can jump in there.
Thank you.
Yeah, you are correct. You are taxed the pension if it's in South Africa, you test of the source, right? There is an application that they can apply for. So it's an IST-01 application with SARS, the South African Revenue Services. If it's already being taxed, that lump sum, they can claim that deduction against and use the certificate in your Thai return. So they can claim that, so they're not paying it twice. And regards to the pensions as well, there is a new system that's being put in place in the South African side. It's called the two-pot system, right? So it's only effective from the 1st of September 2024, where they allow them to pull out their pension and provident funds at the earliest stage. So that'll be limited to the amount of a low of 30,000 Rand and 10% of the actual pension, right? And limited to 2,000 Rand as well. So that's only from 1st of September of this year, though.
Right.
So if they are taxed at that amount, and let's say, for example, they move to Thailand during that time, so that is where they can claim back that tax through the certificates credits on the Thailand returns. So yeah, but that's all from our side.
Yeah, really interesting. Yeah, really interesting. So what can you mention the tax form or the document that you mentioned at the start? What's it called?
Yeah, sure. So it's an RST-01 application form.
Okay.
So that you can get from the SARS websites, and I'll just pop it as well at the bottom so you guys can access that.
Wonderful. Yeah, thanks for that. Okay, so we know that if you remit in the pension, We know that it's in the revenue code for Thailand, so it means that we need to declare pension in Thailand. We can use the tax paid as a credit, and we get a deduction as well up to 100,000 Thai baht in Thailand. So we have to file. It might just be an administration job if your tax rate is higher in South Africa. It just means that we don't pay any extra tax in Thailand. If the tax rate is higher in Thailand, then there might be some to pay. Depends on your circumstances and how much it is and the tax rate. So property rental income. Let's talk about this. So again, it's the same rule. South Africa-based rental income, taxable in South Africa, and then maybe taxed in Thailand. So that means if you transfer in property rental income into Thailand from South Africa, then we can use the tax paid as a tax credit, but we still have to file it. Depends on the tax rate in South Africa. Yeah. So that's pretty clear. Samantha, is there anything to add with property rent?
Yeah, so they can claim the property rental tax based on South Africa and any expenses as well claim. So if you have your bond rates, electricity, so there's a Section 11A deduction that can be claimed against that income as well. So yeah, it's depending on the source of the property. So yeah.
Okay. Yeah, great. So the problem with how we report in Thailand is we just look at what did you receive as a rent and how much tax did you pay. So if you have got a lot of exemptions and deductions in South Africa, it means that the tax we can deduct will be potentially less. How does it work in Thailand? So we do get a flat deduction. So when you transfer in rental income, we can deduct 30% of the amount you transfer in as a deduction. So that's quite good, plus any tax that you've paid in South Africa on there. We have to file twice a year if you're bringing in rental income. So PND 94, which is the half-year tax return, and then the end of the year, which everyone has to do if they've got any sort of income source. So selling a property. So if you sell a property in South Africa, then you've got potentially for capital gains tax in South Africa, depending on the type of property. And then if you remit that into Thailand, then it's also the DTA shows it may be taxable in Thailand. So it means pay the tax in South Africa first on the gain, and then if you remit to Thailand, you potentially taxable on the gains in Thailand as well. So if there isn't much to offset, if there isn't much tax paid in South Africa, it means this could be one of the assets where there's quite a big tax liability in Thailand. If you sell a property in South Africa while you're a Thai tax resident and then bring the money into Thailand, it could mean if you've made large gains on the property, there is a large capital gain that's added to your personal income tax. So Samantha, how does this sort of work for sale of properties? I guess it matters if it's a residence or if it's a rental property, I assume.
Yeah, it does. So if it's an immovable property, like what's stated here.
Yeah.
So for an individual, we have a 40% CGT rate, right? And if it's a company, it's a 80%. And depending now on the amount of money that you're actually moving across to Thailand based on that. So we actually have SARS has a limit of 1 million rand. So if you're moving anything above that, you have to go through a tax clearance to be able to move that money across based on that sale, right? So that's one thing to keep in mind. You're always going to get taxed on everything. So, so yeah, and based on the assets, so there is some personal assets, like for example, your ships, your boats, aircrafts that are excluded from, immovable property and your CGT. So there are a list of it, but yeah, you've covered everything so far.
Okay, great. And then also same rule for dividends. So it may be taxed in the States. There's no exclusions. If you do bring into Thailand dividends from South Africa, then you can be taxed in South Africa on the dividends, and then we can use that tax as a credit, but there is assessable income. So in Thailand, all of the dividend that's remitted is classed as assessable income. So it's added to personal income tax for overseas dividend, not for Thai dividends, for overseas dividends. Investment capital gains, the tax, this is a bit of a nuance and a bit different to some of the other DTAs. So investment capital gains are taxed in the country of residence. So it means if you do remitting foreign source income and the source is investment capital gains, it means they are assessable income in Thailand. I assume this show means that they're not generally taxed in South Africa if you're a non-resident. Is that right, Samantha, for investments?
Yeah, yeah, no, that's correct. But in terms of interest that you're receiving from that actual investment, it is exempt, but it's constituted based on if you're exceeding 183 days, if you're physically present in South Africa.
Right.
If you are not exceeding that, then you're subject to the normal tax on there. And there's also another catch. You've got withholding taxes of 15% if you're not taxed on the normal side of things. Yeah, so that is covered on that.
Seems to be quite a common theme with the South
Yeah,
African revenue
there's
code.
always a catch.
Yes, yes, yes. Okay, great. So investment capital gain, yes. So if you remit into Thailand, you're taxed on the gain. So how does that work? You know, the definition is selling, paying, or transferring, exchanging investments that exceeds the cost of the investment. So we look at the gain percentage. There's two ways that you can work out the gains: first in, first out, and moving average. We've got a webinar specifically for this, so I won't go into this in too much detail, but you can choose the method. So if you've bought at different prices, it might be might be better option and reduce down your capital gain for first in, first out, or moving average cost. It depends on your circumstances. So you can use whatever method you wish, but you've got to use it for this all the way through the same year. So you can't change throughout the year. So it depends on what type of asset you've got to how it's taxed in Thailand. We look at the gain, whatever the percentage of gain that you bring in, that's what we add to your personal income tax. Makes sense? So let's go through a few case studies. I think this is the best way to go through this, just to explain some of the concepts and answer some specific questions at the end. It might answer quite a few of those as well. So we'll go through 4 different situations. So first of all, Thai tax resident, they live in Thailand 180 days or more. They've got a large cash balance in South Africa. So they've got cash from pre-2024 savings, and they transfer 2 million Thai baht into Thailand. So they remit in cash from previous years. If that was the only thing that they brought into Thailand in that year, they don't have a tax liability. It's cash from previous years. They don't need a tax ID number, and they don't need to file. So you can be a Thai tax resident, not have to have a TIN, tax ID number, and not have to file if you don't have assessable income. So that's the first case study, important to note. So not everyone needs a TIN, only if you've got assessable income. Second example, so somebody who, they live in Thailand, they've got an elite visa, they make, they sell 2 million baht of shares in South Africa trading account. They've got large gains, 50% gains, but they don't transfer those remitting to Thailand. So if they don't remit into Thailand, there's no tax liability. They don't need to file, they don't need to file a tax return if it's not remitted into Thailand. But if they ever do remit those assets into Thailand anytime in the future, it's taxable in the year it's remitted. Third case study, someone who receives a rental income. So that's a rather large rental income, 2 million baht per year rental income from South Africa. What they would need to do is they have to file a PND 94 and 90 returns in Thailand. They can deduct up to 30% from the rental property income. And then they can also deduct any taxes paid in South Africa on that rental income. They need to provide the evidence of the rental agreement and the tax paid. And our assisted tax filing service is probably the most suitable for that, where we can claim back the tax credit. So that's the same for all South African tax filers. Really, we want to focus on claiming back those tax credits. So our assisted middle plan is probably the most suitable because we claim back the tax credits on your behalf. So how do we actually do the calculations? So if you are bringing in 2 million Thai baht of property rental income. How does it look? First of all, we take off 30% as an allowance. Then we'd look at your personal allowances as well. So for this specific example, you know, they're under 65, so they get their allowance, the spouse allowance, we deduct off that 30%. So their assessable income, 2 million Thai baht, we deduct off those allowances and deductions. So their actual taxable income will be 1.2 million. Then we look at the tax tables and calculate on that progressive system. So for this specific example, the tax would be 185,000 Thai baht, or 9.25%. Then we can deduct off any tax that's been paid on that in South Africa. That's where we'd use the tax credits. Okay, so last example, yeah, if we have capital gains overseas, so in South Africa, on their investments that they've sold and they bring into Thailand, we can use the first in, first out method or moving average to calculate the capital gains. This is the calculation how we work out capital gains. So if they sold 2 million Thai baht of shares and they had a 50% profit, we use this calculation to calculate what was the original value and what is the capital gain. So on 2 million Thai baht with a 50% gain, if you bring in 2 million baht, then 666,000 is the capital gain amount. So we can use different methods. If you've bought at different prices and sold at different prices, we can use moving average cost or first in, first out, depends on your circumstances. If you would like to go through a tax calculator, we can go through that with yourself. We have a free tax calculation service online. So you can book in a time to chat with my colleague, Jason. He's an expert at calculating the tax in Thailand. You can go through that and get a good estimate for yourself and really get the assessment, so how we can claim back the tax credits. If you'd like to go through a strategy call and you'd like a personal meeting to go through this, you can book in a consultation with myself or one of my colleagues as well. So we can have that online or in the office. Okay. The rules have changed in Thailand for foreign source income being remitted to Thailand. Now, how will Thailand actually deal with this? How will the Thai revenue know? Well, it's important to know that Thailand signed up to something called Common Reporting Standards in 2020. And it's basically, it was an OECD countries that put this together in 2016. There's now over 120 countries that have signed up for this, including South Africa. And it's basically a global initiative to stop people avoiding tax liabilities. What does that mean in principle? It means every year, if you are a Thai tax resident, and you have South African assets, so you have a bank account and a pension and investment assets, every year, those banks, credit cards, investment platforms, they send the data for yourself to the South African Revenue Department. So they send your account balance, transactions, ins and outs, and your main details. And then every year, the South African Revenue Department send that information to the Thai Revenue Department for all Thai tax residents. So now they have full transparency on all the accounts. So that's the way that, they can keep track of this, and that's how they know. So obviously the implications of not declaring your tax obligations in Thailand, same as South Africa, same as every other tax authority, they're pretty punitively taxed and charged. So penalties for failing to provide file of tax returns up to 200% of the tax that's owed, plus a 1.5% surcharge for each month the tax was owed, plus penalties for avoidance and potential imprisonment and fine up to 200 grand. So yeah, the penalties are quite harsh, same as all tax authorities. Non-compliance is not really an option. So it's the services that we can help with. If you'd like to take advantage of our free tax calculator video call, feel free to book in. We'll send the link out. That's really useful for a lot of people. We obviously have Thai tax filing services. so we can help you stay compliant. Everything's online. You don't need to visit our office, fill out our online application and portal, client portal. We can also help people get Thai tax ID numbers if they need that. We've got a service for this. Just remember, we are here to help. So if you've got any questions, just send those across. We've produced a guide for how to file and how to deal with these new taxes. And also our website, we've got a lot of frequently asked questions. I really recommend that you sign up for our tax alerts because there will be further changes. We'd really to make sure that you're kept up to date with any future changes for this. So let's get on to the Q&A. So let's go on to a few of the ones that were received by email first. So first one was, are withdrawals from a South African pension fund taxable if remitted to Thailand if I live in Thailand full time? So I think that's pretty much been answered in the presentation. Yes. So first of all, like Samantha mentioned, it's deducted at source. And then if you remit in those assets into Thailand, then you have to declare that on a tax return and potentially claim the tax back. Yeah, okay. Next question. I worked for the government of South Africa for 25 years and I've been living in Thailand for the past 3. Receiving a monthly pension, which is deposited into a South African account, and then I would transfer most of the money to my Thai bank account to cover all my expenses. Will my pension be taxed here in Thailand? So if you have a government pension, so civil service pension, then under the double taxation agreement, this is exempt from Thai personal income tax. What does this mean? It means you wouldn't have to file a Thai tax return if it was a government pension, but you'd still have the South African obligations. Is that right, Samantha?
Yeah, that's right.
Okay,
You'll
great.
definitely be taxed. There's a lump sum tax table as well for pensions that's being taxed, and plus your normal tax table for your annuity that you're receiving every month.
Okay. Yeah, great. All right, so let's go through some of the questions that have come in. So my husband and I are both pensioners. We're thinking of moving to Thailand. Would you advise if we should file jointly or separately to individually to have better allowances? How does this work? Right, okay, so let's talk about for the Thai side. Let me go through to the slide. That might be easier to go through actually. Let's load the slide up regarding allowances. Second while I find it. Okay, yes, this is one. So depends on your age. If you're 65 or older, then you get 190,000 allowance each if you file separately. If you file jointly, you've got, if you've both got an income, then you can't file. If you're remitting in the income to Thailand, you can't file jointly anyway. The only benefit of filing jointly is you take the other person's allowance. But if you've both got an income, then you need to file separately anyway. So I hope that answers the question. Okay. Okay, so this is a question that Samantha might be able to help with as well. With the 10.1 Tax Act from SARS, where you are tax exempt for the first 1.2 million earned if you spend 183 days or more outside of South Africa. How will this be offset with tax credits if funds are brought into Thailand? Well, I think, to be honest, it just means you've got a lower tax to deduct, right? So, Samantha, there's not really any in Thailand. It just means you've got less tax to deduct in Thailand. I think that's right, Samantha, is that?
Yeah, just straightforward. So it's just that because you already would have gotten taxed in South Africa, that tax credit that you can then bring into your Thailand tax rate. That's the only thing. And just about, if you're bringing above 1 million rand, you have to get a tax clearance to be able to move that money out from the South African side. So I think that's straightforward.
Okay. Yep, fine. Thanks for that. Okay, one more question about the LTR visa. So I've had quite a few about this. So let's bring up the LTR bit of information. So I'm in the process of obtaining an LTR retirement visa. If I get it before the tax deadline, will I be tax exempt or will I still pay tax on funds brought in before I received the visa? Okay, very good question. So I'll answer this. Samantha's Thai visa status, really. So the LTR visa is it's got a royal decree on foreign source income. What does that mean? It means under the Thai revenue code, there's actually an exemption from foreign source income, but the criteria states that the income has to be remitted in the following tax year. This is under all categories apart from that highly skilled professional category. So if you've got a retirement, this person mentions about an LTR retirement visa. What does that mean? It means if you get the LTR visa this year, so before 31st of December, then that means if you bring in income that was earned, so for next tax year, so next year, if you bring in the income that was earned this year, then there'll be no tax on, it's exempt from income tax in the following tax year. So if you get it this year, it doesn't really help you for income that you bring into Thailand this year, because the rules state in the revenue code that you have to bring in the income in the following tax year. So it would mean for you personally, I don't know about the funds that you brought in this tax year, but it means if you have brought in income this tax year and you get the LTR, doesn't matter if you get it or not, you still got to file a tax return. You can use obviously the tax paid in South Africa as a credit. So it might be more of an admin job than with a tax to pay. But the LTR won't, if you get it in the same year and you remit in the income, it doesn't really work. You've got to basically get the income and then bring it in the next tax year. So you could have income paid out now into South Africa in October, and then on the 1st of January, assuming you get the LTR this year, bring in that income to Thailand, and then it would not be assessable income because it's income that's brought in the following tax year. I recommend that you do watch the webinar on LTR specifically. It might give you a bit more guidance on there. So I hope that helps. Let's look at another question. Our banks have closed and shut down over the last few years where I have cash saved. I've transferred this away from them luckily to another bank, but how can I provide this was cash early from previous years? So good question. So if you are, let's assume that you're a Thai tax resident now and you've moved to Thailand already, then what the important announcement, this one, let me load it up. It might be useful even though it's in Thai. This one on the right, the 20th of November announcement. This actually mentioned about cash in the bank from pre-2024, that this is not assessable income. So if you can show the cash balances as of the 31st of December 2023, then this can be remitted to Thailand anytime in the future using first in, first out method for the account balance. So I hope that's useful. If you've not moved to Thailand yet, so let's say you're not a Thai tax resident this year, then this rule applies for the next tax year. So let's say you move on the 1st of January 2025. It means the account balance as of the 31st of December 2024. That balance is not assessable income in Thailand because it was all earned or from previous tax years when you were a non-Thai tax resident. So I hope that is useful. Any other questions? So that's all the ones that I've seen on there. Yeah, I hope that's been useful. Thanks for listening. I really appreciate your time, Samantha, to help. Maybe if you could just give me a bit more information about your company. So if anyone needs to do any South African tax returns, how can they get a hold of you? We'll put your details in the notes, but maybe if you could just give us a few scenarios when you would be able to help non-tax tax residents file in, what kind of situations would your services be useful for?
Sure. Thanks, Carl, for this opportunity as well. So my company is called Excellence Accounting and Tax Services. So our services branch from bookkeeping, payroll, tax services, income tax return. And in terms of the non-residents, so what I've been offering services regarding is if you had moved to, let's say, Thailand, or another country, and you have been in South Africa for a portion of the year, and you've been receiving foreign income for another portion of the year, you'll also need to declare that amount on the South African tax return. So in that instance, I would still have to be able to help you to declare that amount, work out the amount of days that you were physically present in South Africa and those that you were outside of South Africa. And then we need to obtain the tax directive as well, for those amounts. So I can assist with those type of services. In terms of payroll services, your employee tax services within South Africa, your PAYE, any, registrations, income tax registrations, I do. So yeah, my services branch out throughout. I'm a CA and a tax practitioner, so the accounting side of things I'm also doing. So your valuations of companies, also your business profiles. So yeah, it's exciting, and I'm open to anything that comes my way. And I'm so grateful for this opportunity you've given me, Carl, to be able to speak on this platform as well. So I will give you my email address and my website if anybody is interested to contact me, and I'm happy to help.
Yeah, great. Yeah, really appreciate that, Samantha. That's really helpful. Thank you for your time, and thank you for joining the webinar. If there are any more questions, feel free to send them by email. I'll make sure that you get back to you. Thank you for joining, and have a good evening. Bye-bye.